Welcome to the NFO review series. In this video, I'm going to be reviewing the Nippon India Nifty Smallcap 250 Index Fund. As the name suggests, the fund invests in stocks in the same proportion as held in the Nifty Smallcap 250 Index. The Nifty Smallcap 250 Index basically consists of 250 stocks, and these are stocks which are the bottom 250 stocks from Nifty 500. Just to recap, what is a small cap? A small cap is a stock which has market capitalization less than 500 crores. Now, if we were to look at the current index constituents, you will find a combination of consumer durables, finance, information technology, industrial products, and so on and so forth. And of course, the index keeps changing every 6 months. Being an index fund, the costs are expected to be low. So should you invest? Before deciding to invest, you need to remember a couple of things as far as small cap stocks are concerned. Now, small cap stocks are always extremely risky, and that's because these are upcoming companies which are expected to do well. But small cap stocks have two big issues. One is liquidity, which is that it may not be very easy to enter and exit the stock. And the other is the impact cost. Now, the impact cost is the price movement caused by placing an order on the stock. So, for example, if somebody places a very large order for a particular small cap stock, then it could impact the price of the stock because of the fact that there is not much liquidity that is available in these particular stocks. If we were to look at the small cap index, one of the other issues is that the best stocks grow to become mid cap stocks, and the worst mid caps actually become small cap stocks and become part of the small cap index. Unlike actively managed small cap funds where the fund manager has the choice to pick up stocks based on his analysis, this cannot happen in the index fund. Also, actively managed funds have 20 to 25% allocation to large caps and mid caps, and to that extent, they are able to cushion some amount of the volatility and the returns as well from downside. When you consider the small cap index fund, one of the things that I expect is that the tracking error is going to be slightly higher because remember, to replicate the index, firstly you have 250 stocks and then the index is changing quite regularly on a 6-monthly basis. So to replicate the index may not be very easy, due to which there might be a lag in performance which is known as the tracking error. Tracking error is one of those parameters that is used to also track index fund performance. Coming to the performance of the small cap index, well, clearly Nifty 50, which is the large cap index, has been able to give better returns with lower amount of volatility. And if we were to look at the actively managed fund versus the Nifty 250 small cap index, you would see that the active funds have actually performed much better. And as you can see in the graph, even Nippon's own small cap fund has given much better performance as compared to the index. You can also see that the category, which is the small cap category of mutual funds, has again given better performance as compared to the Nifty 250 small cap index. My take, I would rather play the small cap space through an actively managed fund, and with the changes in the multi-caps, where now multi-caps have to have at least 25% exposure to small cap stocks, I think a better way for conservative investors who do want some allocation into small caps could be through the multi-cap funds. If you are an aggressive investor willing to take a lot of risk with a longer term time horizon of 10 years and above, the actively managed small cap funds are a much better option, because clearly when we look at the past performance, active management in the mid cap and small cap space has given much more alpha than investing in the index. So don't choose the index fund just because the costs associated are much lower. The index does have its own challenges, and hence you're better off with an actively managed small cap fund. Make sure you click on the bell icon to subscribe. Do write in with your comments. Cheers.